If you buy a house in cash instead of renting, here's what actually happens to your net worth over the next 20 years. In almost every realistic scenario, you end up poorer than if you had rented and invested that same cash. Not by a small margin either, by hundreds of thousands of dollars. That sounds backwards, because paying cash feels like the responsible move, the debt-free move, the move your grandparents would be proud of. But there is a cost to paying cash that never shows up on a closing statement. And today, we are putting an exact number on it. Say you have $350,000 sitting in a savings account. Maybe it came from an inheritance. Maybe you sold a business. Maybe you just spent a decade grinding and saving. You are deciding between two paths. Path one, you buy a $350,000 home outright in Tampa, Florida. No mortgage, no lender, no monthly payment to a bank. Path two, you keep renting a comparable 3-bedroom home for $2,100 a month, and you put the entire $350,000 into a total market index fund. Picture the actual closing table for a second. There's no loan officer, no stack of disclosure forms about interest rates, no 30-year amortization schedule printed out for you to sign, just a title agent sliding a cashier's check across the table, a deed, and a set of keys. It feels clean. It feels final. And it is the single biggest one-time transfer of wealth most people will ever make out of the market and into a single, illiquid asset sitting on one street in one zip code. On the day you buy the house in cash, the numbers already look strange. Closing costs on a cash purchase are lower than a financed one. No loan origination fees, no lender's title policy, just the basics. Attorney fees, transfer tax, and owner's title policy. That runs somewhere between $5,000 and $7,000. Call it $6,000. You walk out of that closing with a paid-off house and zero debt. Your monthly housing cost from that point forward is property taxes around $300 a month, homeowners insurance around $130 a month, and a maintenance budget of roughly 1% of the home's value a year, which comes out to about $290 a month. Total monthly cost to keep a roof over your head, $720. Compare that to the renter. He is paying $2,100 a month, and that number does not sit still. It climbs every year his lease renews. So on pure monthly cash flow, the cash buyer is actually winning by close to $1,400 a month right out of the gate. This is the part people usually stop calculating at, and it is exactly the wrong place to stop. Here is what nobody puts on the whiteboard. That $350,000 the cash buyer spent is gone from the market the second the wire clears. It stopped compounding the moment it became a house. The renter's $350,000, sitting in an index fund earning roughly 8% a year, the long-run historical average for a diversified stock portfolio, does not know or care that a house exists. It just keeps growing every quarter, whether the renter thinks about it or not. Run it forward 3 years, and the gap is already visible if you know where to look. The cash buyer has spent about $6,000 getting in and roughly $26,000 in property taxes, insurance, and maintenance over those 3 years. His home, appreciating at a realistic 3.5% a year, is worth close to $387,000. That's his entire net worth from this decision. Home value minus zero debt, so $387,000 flat. The renter has paid about $75,000 in rent over the same stretch, money he will never see again. But his $350,000 has grown to roughly $441,000 just from market returns, untouched, no extra contributions. He is already ahead by more than $50,000, and he still has the flexibility to move, rebalance, or pull cash out on a Tuesday afternoon if he needs to. By year 10, the picture gets harder to ignore. The cash buyer's home has appreciated to around $493,000. He has replaced a water heater for $1,400, patched a section of roof after a storm for $3,800, and spent a summer arguing with a contractor about a cracked driveway slab. His total net worth, home value with zero debt, sits at roughly $493,000 minus whatever cash reserve he still has left after those repairs. The renter's portfolio, that same $350,000 compounding quietly at 8% with zero maintenance calls and zero contractor arguments, has grown to approximately $756,000. His rent has climbed to around $2,860 a month, noticeably higher than where he started, and it stings every renewal. But even paying that higher rent, his liquid net worth is more than $260,000, ahead of the guy who paid cash for a house. By year 20, the gap stops being close in any sense of the word. The home, still appreciating at that same 3.5%, is worth roughly $697,000. That is a real number and a real asset, and the cash buyer owns every dollar of it outright. But the renter's $350,000, left alone in the market for 2 full decades, has grown to approximately $1.63 million. Even after 2 decades of a rising rent bill, now sitting around $4,150 a month, the renter's total position is still more than $900,000 ahead of the cash buyer's home equity. Push it to year 30, and the cash buyer's house is worth close to $982,000, an impressive number if you only look at that one line. But the renter's portfolio has crossed $3.5 million. That's not a rounding error. That's the cost of taking $350,000 out of the market for 30 years, wrapped in monthly maintenance bills and property tax increases along the way. So why does anyone pay cash for a house? Because this math, as clean as it looks on a screen, assumes something that is not true for everyone, that the money would have actually stayed invested. A lot of people who keep $350,000 in cash instead of a house do not leave it quietly compounding in an index fund for 30 years. They move it around, they chase a hot stock, they panic sell during a downturn, or they just slowly spend it down $5,000 at a time until it is gone. A paid-off house cannot be casually spent away. You cannot accidentally liquidate your living room. That forced permanence is worth something real, even if a spreadsheet cannot price it. Paying cash also removes a risk that this whole comparison quietly assumes away: market risk. The renter's $3.5 million at year 30 assumes the market delivered its historical average the entire time, with no lost decade, no prolonged downturn right when he needed to access the money. The cash buyer never has that exposure. His house does not crash 40% in a single year the way a stock portfolio can. It also cannot be evicted from, repossessed over a missed rent payment, or sold out from under him by a landlord who decided to cash out. Think back to 2008. Home prices in some markets dropped 30% and stayed underwater for the better part of a decade. But the people who owned their homes outright never got a margin call. Nobody showed up asking them to make up the difference. They just kept living in the house while the paper value recovered on its own timeline. There are also situations where the math flips entirely in favor of paying cash. If you are retired and living on a fixed income, the certainty of zero housing debt and a locked-in low monthly cost can matter more than any theoretical portfolio growth you might miss out on. If you know yourself well enough to admit you would not actually leave $350,000 invested and untouched for 20 years, then the version of you who buys a house in cash ends up wealthier than the version of you who was supposed to invest the difference but never did. And if you are buying in a market where prices are already inflated relative to rent, a cash purchase locks in your cost basis before prices climb further, which the pure math here does not account for. The honest answer is that paying cash for a house is not a financial strategy. It is an insurance policy. It protects you from your own future decisions, from market downturns, from ever facing a mortgage payment again. That protection has a price, and now you know exactly what it costs. Somewhere between several $100,000 and several $1 million over 3 decades, depending on how disciplined you actually would have been with the alternative. If you are the kind of person who would genuinely leave that money invested no matter what the market does, the numbers say, don't buy the house in cash. If you are not sure you would, the numbers say the house might be the smarter bet anyway, because a plan you actually follow beats a better plan you abandon in year 4. Which one are you being honest with yourself about? Drop it in the comments, and I will see you in the next one.